Hello guys, welcome back to another lovely trading video. In this one we're going to be doing a strategy video on how I kind of trade the stock market, how you can kind of do the same sort of strategy, and then different ways to trade it, whether you want to use stocks or options, because there's really three ways we can trade this, and that's going to be either just buying the shares or shorting the shares, and then two different kind of option strategies, one being debit spreads or vertical spreads, and then another one is just buying, just calls or just puts, but we're going to show you how to kind of pick the best options to do each of these strategies. Now for this, and you can see on the chart now, this is really all you're going to need. The chart is called, well, the indicator we're using is called standard deviation channels, and that's really all we're going to use. And so to quickly show you how you add them, all you got to do is go to studies, standard dev channels, which is quite easy, as you can see there, standard deviation channels or standard dev channels. And you're going to add 8 of them, and you're going to do the same configuration here. We're not going to go over it, how to set it up completely in this. I will put it in the top link in the description, because I want to keep this video under 20 minutes, because I know if it's 30-40 minutes, no one's going to watch it, you're going to get bored. So I'll put that in the description, so if you like the idea of the strategy and then you want to actually add it to your own chart, you can then go and just watch that video and see how to set it up. And then the only other strategy, the only other indicator we like to use really is the RSI. And then if you're taking the option side of things, it can be good to have the implied volatility chart on. But either way, I'll quickly do a rundown of how standard deviation channels work, and then we'll get into the rest of it. So if you already understand standard deviation channels, standard deviations in general, then it's very easy to understand how these works. And all you need to do is look at these golden lines, which are the first deviations, and then if you already know standard deviation and how it works, 68% of the data will lie within these first deviations. Then you go to the second deviations, so these blue ones, 95% of the data will lie within these. And then the third deviations, you should have 99.7% of the data lie within these. So knowing that, when we look to trade, we're really looking to trade at the second or third deviations. We tend to ignore the first deviations, and the reason for that is if 68% of the data trades within it, it means 32% of the data doesn't trade within it. So if we go down to the second or third deviations, there's a lot higher probability that the trade will work, and there's a lot less time that if the trade doesn't work right away, that we'll be in a losing position. So yeah, when we're looking at the chart, then all we're really paying attention to is the second and third deviations. Now for this as well, we use a 4-hour and a daily. You don't tend to use these on a lower time than that, because they just won't be as strong. And you can go out, to a yearly chart or something like that, but really we tend to just stick to these two. So then what we would do is now kind of go over NVIDIA and how we would look to analyze it, and then we'll go over a trade example. So all you need to do again is look at the second and third deviation. So all we will do is just plot where each of these are. So on the 4-hour, we've now plotted all our support and resistance lines, and then we'll go over to the daily chart and do the exact same thing. Second and third deviations, there we go. Now we have 4 levels on the bottom and 4 levels on the top. Again, these levels will be used differently. If you're looking at these levels on the bottom, this is more where you're looking to get longer stock. If prices were up at these high levels, so the 303, the 333s, these are where we'd be looking more to short a stock. But for this, we will kind of just go over the lower half of it, because a lot of people don't like shorting in general. So really, it's the same idea. You would just do it from the top. But if you have any questions anyway, you can always just ask in the comments. Now, seeing this, we can see NVIDIA has already hit its second deviation on the daily. So seeing that, that's how we would look to trade it, and this is why you have a watch list full of stocks, so you can catch these stocks before they hit their deviation. And so now we'll kind of go through a trade breakdown on how we'll do it. So we'll go back in time to make everything a bit more clear. So we'll go to May 23rd, and the reason for this is when it hits its second deviation. As you can see, we're sitting at it now. Actually, we can do when it originally hit, so we'll go back to the 11th of May, when it originally hits its second deviation. So here we are now. We'll even update this for us, and we'll put it at $178 is roughly where the second deviation was if you were watching it live. So when we see this and we see the stock come down to it, our alert would have gone off, and now we'd be looking to get longer stock. So again, so there's multiple different ways you can trade this. If you're looking just to buy shares, really all you would do is have a limit order coming into that level. So at 177.50, you would just have a long your shares to go long at that limit order. Now, how you pick your stop is totally up to you. You can either do it on a risk to reward basis, so you see where your target is, or you can just look at the next deviation and you say, if it breaks below there, I want to get out. So we can see the closest deviation in this case is 164, so we could say, okay, if it breaks out 160 level, then we look to get out of the trade and it will come out as a loser. Another way to see a stop loss will be, let's say our target is going to be, for example, $202. That would be what we'll do for an example. We can see that gives us, a 14% upside. You could do a 1-to-1 and say, okay, if it falls down to 14%, so $152, we will get out. Or you could say if it falls, half that to around 7%, so $165, we'll get out. But again, doing your stop loss, that's going to be totally up to you, and how risk adverse you are. If you're going to take on a lot of risk, obviously you have bigger stops, and all of that. But either way, we would look to get long then around this $178 level. Now, where are we going to be getting out of this trade? So we went through how we kind of calculate stop loss very briefly. Now, how will we find our targets? And again, all we need to be looking is at the standard deviations. Like I said, that's all we really use for this strategy. It's just standard deviations. And so all we will do is just look at any standard deviations which are above our current level up to the closest statistical mean. So we have the $203 level, which is the first deviation on the 4 hour. We then have the first deviation on the daily, which is at the $222 level, and then we have the statistical mean at around $240, and that's going to be our final target. So if you're looking to trade to kind of the max profit, that's where we'd be looking to close out of our trade completely. Now, why do we only trade to the statistical mean and say not to the upper deviations? The reason for that is this is a mean reversion strategy. And so once we get back to its mean, really, we just want to be getting out the trade, because it's a lot more of a gamble where it will go from there. If we're looking to trade to its mean, once it goes to its means, it could continue going up. It could then end up falling from there. So really, we just look to trade to its mean, and that's where we'll get out. So seeing this then set up, we'd be looking to get long at 177, and then we'd be looking for around a 35% or 30% upside to around $235, $240. So yeah, if you're just using shares, that's really all you'll be looking to do. You'll have your stop loss in place. You'll have, maybe you lock in 20% of profit at the 203 level, another 20% at the 222, and then the last 60% at its final target. Or you could just look to hold it all to the mean, and just move your stop as it goes. And really, you can pick and choose how you do it. The overall strategy is just getting long when you come into a standard deviation, and then having our targets along the way at the upper deviations. Now, so that's how you use shares. Now, if you're looking to trade options, how can you do it? So firstly, we'll go over debit spreads and how you can trade it with kind of these vertical spreads. So what we would firstly do is, obviously, you've got to go over to the option chain, and this will kind of take some practice to kind of realize how stocks move. And I mean, if you've been in the market for years, you'll probably know a lot more than someone who's been in there, for a few months. But really, all you want to see is kind of where the stock is now and how quick do you think it's going to bounce. Do you think it's going to bounce, within the next 2 weeks? Or if the overall market is selling off like it is now, could it take a bit longer, 2-3 months or 6 months or so like that? And because this will be an important factor on how you pick your options. So in this kind of market, and if we go to the futures at this point in time, we can see they have been selling off quite heavy. So to me, That would make me want to pick a later expiry, because I don't know if it's going to bounce right away. Yes, the stock seems to be so-called cheap at this level, but could it keep falling? Of course. If the market keeps falling, then the video will keep falling. So really, we want to go out for a longer expiry, because we want to buy time on this. And this is a handy thing with options over the shares, is we can kind of customize the trades to pick our benefits. And that's a benefit with debit spreads, is we can pick, or we can kind of buy time. So we can say, okay, we don't think the video is going to bounce for 2 months, or it might take 2 months to kind of get towards our target. Then all we need to do is go out to that option chain, or that option row of about 2 months out. So in this case, we'll look at the 15th of July 2022, and then we can see that that's 65 days away. So that's pretty safe. We would say, okay, we expect the stock to bounce to there. Then how do we trade this? We can actually see that the options don't work in on-demand mode, so we're going to have to go to current time. Which may make things a bit confusing, because we're going to have to use different prices to get accurate levels, but just pretend we're looking at the 160 call and the 165 call, because if we're watching the market live, that's what we'd be looking at. But as we're looking at this market, we have to be using the 190s, because that's where Nvidia currently is. But all you would do is you would look to buy the 190 call, and you would look to sell the 195 call. And what this does is creates a debit spread. So you have credit spreads and debit spreads. Debit spreads means you pay the money up front, and this is how I always prefer to do it, because then okay, if you carry on trading, that money's already left your account. You can't lose any more than what's in your account right now, and so it just makes it a lot easier to track, especially if you're starting off. And once we see this, okay, we've created a debit, and it says it's going to cost us $2.38 dollars, sorry, $2.38. So when we see that, we know that's going to cost us $238, because obviously options you times by 100. So this trade, it's going to cost us $238. What is our max win on this? Well, all you have to do is look at the difference between the strikes. So here we have a 190 and a 195, so there's $500 to be made. We're paying $238, which means then our upside on this trade is $262 with a max risk of $238. And so really all this trade requires is that in the 65 days time, Nvidia to trade above the call that you bought. So in this case, obviously it's a 190 and a 195, but when we were looking at before, and if you're trading in the live market, this would be the 160 and the 165 call. And really all it means is that in 65 days from then, as long as Nvidia stays above that 165 call, then you make your max profit, in that case $262. Now how can you make this trade a better risk to reward? Because usually you'll be looking at a 1-to-1. If it's less than 1-to-1, we won't take the trade, but yeah, more times than not it'll be around, you'll make $250 if you're risking $250, or maybe $10 here and there. So you're risking such as this case, you're risking $238 to make $262, but usually it's near enough 1-to-1. How can you make a better risk to reward? Usually you can just go out a further expiry. So in this case we could go out to a 205. So now we're risking 15. Well, now we have a difference of $15, and in this case we're risking $625. So all you really need to do, and again it's quite easy to do, all you have to do is, you can use a calculator, or you can do it all in your head. If you're looking at a 15-point move, that is the difference in strikes. You're paying $625 or $6.25. That means your max reward on the trade then is going to be $875. So obviously it's a bit better than a 1-to-1, but usually for this you then have to take more risk in the first place, just because obviously the debit spread is going to be more expensive. That's really how you trade, and yeah, you get your max profit as long as expiry you're above your other call that you're shorting. As long as you're above that, you make your max profit. So yeah, quite simple, quite easy. I mean, it's a way I'd say probably my favorite way to trade if you don't know how long it's going to take to bounce, or if you're uncertain how long it's going to take to bounce and you don't want to be holding shares. And that's one thing that's happening right now, is in this kind of market where the market's selling off heavy, I don't want to be holding shares of these companies, because if they can fall 10% in a day, that's a lot of money if you're holding 100 shares, whereas you can limit that risk by doing the debit spread while still getting some of that upside. Now, the last way to trade this strategy, or at least the last way I trade this strategy, is just using normal call options. And again, if you're looking to short a stock instead, you can just use normal put options. And again, I would tend to do this the same way. I would just look for a further out expiry. The reason for this is in the last 60 days of options, that's when they time decay the most. So if we're looking to be long an option, we don't really want to be holding during these 60 days unless we really have to, just because we're going to be losing a lot of money that could be saved by just going out to a further expiry. So usually I'll go for about 100 days out. So in this case, the 16th of September. And then I'll just use quite a far out the money call. Because for this one, we're not looking to hold to expiry like we would to the debit spread. And so looking at NVIDIA now, we can see, okay, our target is 217. We're not actually going to look for a 217 call because they're going to be quite expensive. And unless you have quite a big account, you probably don't want to be doing that. So yeah, 217, you'd have to put down around $1,000 to trade that just as a normal call. So how else can we trade this? Well, if we open up the whole option chain, we will tend to trade ones further out, say a $300 call or a $320 call, where they're going to cost us, around $50 to $100 per option. Now, why do we do this? Well, again, if you have a smaller account, it's definitely a lot more easier to afford because you're not risking $1,000 on a trade, you're risking $50. But at the same time, you also do have exposure to a lot of the upside. Because, for example, we're buying this 150 call, and the price goes up to 20 points or 10 points, however much we think it's going to go to. It goes towards our target either way. I think our target was 217, so as long as it's pushing towards there, this call is going to go up either way. And by the time Nvidia's at say $215, this position's still going to be up 200%. Yes, this call may go up more percentage, but we don't want to be risking that we don't really want to be risking $1,000 on just one trade. And again, unless you have a bigger account and you're happy to take this kind of risk. But for me, I tend to prefer going out with smaller sizes and going out for further out calls, and then I can tend to do the same trade on say 3 different stocks, and then if 2 of them work out or even just 1 of them work out, you tend to at least if 1 of them works out, you tend to break even, but more likely than not, at least kind of 2 of them tend to work out. But yeah, so all we really do is just look for cheap break evens, and by break evens you really just means cheap to look at. If they're $50 or $50, we see that relatively cheap because then the break even on that is $320.50. Obviously, we're not expecting it to get to that level. We're really just looking to make money on the premium. And again, that's why I said we don't tend to get ones that are closing within the next 60 days, because that's when they tend to lose a lot of their premium in time decay. So yeah, we tend to get them 100, 120 days out, and then it gives us 40 to 60 days before the premium theta kind of starts to kick in. And now quickly I can actually show you this trade on JP Morgan. So and this is what I mean by getting the cheap option. So here on JP Morgan, we bought this when the stock was around $115, I think, yeah, $115, and they were only $29 per call option. So we did that again about actually this time we didn't get even that long out expiries. We only got about 60-day expiries, which is not the best idea always, but if it moves quickly, which like we expected to in this case, you can take on that extra risk. But yeah, so we only paid $30 a contract, and then we can see once JP Morgan jumped, to $125, these options were up 400% to $135. So it just shows you how that kind of strategy works. You're not risking too much, but there is still a lot of upside. You can see I only bought 3 contracts, so I was only risking $90 on the trade, and then it ended up making, $300 relatively low risk, at least I would say. So really that is the overall trading strategy. Looking at standard deviations, looking to get long when they come down to its second or third deviations, or shorting when it comes up to its second or third deviations to the upside. And again, trade them in different ways, stocks and the options. You may be happy to do all 3, but it may be more of a case, what is the best one to do? Again, shares, if we're in a bull market, I'm usually quite happy just to hold the shares. If I'm ever looking to short shares, I don't tend to do that. I will instead tend to just do an option play on it. So you can do a bear, debit spread. But yeah, so really they're going to be the 3 main ways: shares, debit spreads, or just getting actual calls or puts for it. Tend to be cheap options that expire quite a while away, and yeah, they tend to be under $100 a contract. So I hope you enjoyed the video. If you do have any questions on the strategy or the kind of trading pattern, so the shares or options, how to pick them, just let me know in the comments and I will reply to any questions you have. So I hope you enjoyed the video. If you did, don't forget to drop a like and subscribe. Hope to see you next one, and that's it. Peace.
And maybe I'm crazy, only you can save me.